Hello and welcome to this webinar. My name is Stanislav Bernikov and I'm a full-time professional trader with more than 10 years of experience. I will be a host in this webinar where I'm going to share with you some interesting information concerning trading. If you have any questions, feel free to leave them below this video. Enjoy! Let's get started. This webinar is dedicated to most common trading mistakes and how to avoid them. Warren Buffett once said that investing is ability to say no to 90% of opportunities. Trading is no different. Every trader can find good trade from time to time, and it's not good trades that make us lose money, it is bad trades. That's why this webinar is so important. We have to learn how to filter bad trades. Most of my profitable setups that I use for profit over and over again are based on previous trading mistakes. And my real development as a trader has begun when I've honestly and mercilessly analyzed my trading performance until I have found repetitive patterns that I must have eliminated from my trading to be able to show consistent profitability. So I invite you to listen and make notes if necessary. Most of ideas discussed in this webinar were somehow used for trading either for me or students of my educational groups, so they are based on practical experience. Before we start, let's take a quick look at the disclaimer. Please beware of financial risk associated with trading. Information in this webinar is provided for educational purposes only and by no means can serve as a trading or investment advice. You will have full responsibility for your trading decisions, so we strongly encourage you to test any ideas or concepts on a simulator or using a historical backtest before putting real money at risk. Now we are ready to start. And I want to start with the idea that may be not too popular or well known among traders. Not too many traders think about the fact that there is no common way to success in trading. You can't just take someone else's strategy, execute upon this strategy and suggest that now you have an edge which you can reproduce over and over again. Making certain steps may not help you become a better trader. You will have to find your own trading style or your trading niche, combine your market understanding with self-understanding and eventually to create your own set of rules, focusing on limited number of trading setups. Yet there are common ways to fail in trading. I am not even talking about employing high leverage without being aware of risks, but it is all about decision-making process. Even if our money management is okay, we nevertheless might make bad trading decisions. The reason for that is that our interpretations of what is going on in the market are often irrelevant, or they can be irrelevant, especially for beginner traders. We simply tend to read the market incorrectly. So do the majority of traders, even in hedge funds, in large proprietary trading firms. They also tend to do the same mistakes just like you or anybody else. And in this webinar we will go through most popular trading mistakes to help you recognize similar situations in future and become better traders. And one thing more, can contrarian thinking help you develop an edge? Not necessarily, because if you know that you shouldn't buy here at this point at this time, it doesn't automatically mean that you must sell here. Too often opportunities are very limited in some market conditions, and the best trade is to be in cash and to avoid trading at all, sitting on the sidelines. Well, not all the time, but most of the time it is the best trade you can ever make, sitting on the sidelines. On this slide I have put most common trading mistakes which I was able to observe many times working with traders as a trading coach and in my own trading in the past as well. First of all, it is what I call high-low price fallacy. Markets sometimes can make us believe that current price is unfairly high or low, and we can be involved in a trade that is not good at all. Secondly, it is catching tops and bottoms. Many trading accounts were destroyed just because trader was overconfident about possible reversal point. Later in this webinar I will show you that catching tops and bottoms is one of the most dangerous and destructive types of mistakes traders ever make. Then traders tend to pay too much attention to volatility. They wait for the break to enter a trade and not surprisingly they come to the party when it is already over. Also traders often rely on levels rather than areas Ignore market conditions and search for one good trade that will solve all traders' problems, that will bring all the money in the world instead of operating within chosen time frame, even though profit in a single trade will be limited. And before we get to the point, I want to say a few words. If you want to become a good trader, you will have to learn not to argue or even fight the market. Current price can be unfairly low or high from fundamental perspective, but first it has to be recognized and confirmed by the market. If you feel that current price is good but nobody is really interested in buying or selling at this point, maybe time has not come yet. Sometimes market has to go sideways for a while to make several tests to both directions until it is ready to go. So don't fight the market. I want you to remember these words as most important in your trading education. Now please look at this slide. How do you think? Is price high or low here? When I ask these questions to students of my educational group, some of them say it is relatively high because we have previous trading range. We had consistent rejection of higher prices before, that's why this price is high. Others say that this price is not high at all because we had a trending move that is about to continue, so this price may be medium or even low. And very few of them say that the question doesn't make sense. Our perception of high and low price will depend on our time frame, on our viewpoint that we are watching from. If you watch from highest time frames, the picture can be completely different. On this slide you see a recent example of American dollar versus Canadian dollar, and it is very easy to say that we have a high price here, or relatively high price here, because we have several reference points here. We had trading range with highs and lows, and comparing the current price with these reference points, we can easily identify that this price is relatively high. If we watch this chart from different perspective, for example from daily chart, the picture becomes a little bit different. First of all, we have a trending component here. We have rising highs, rising lows here, and it is no longer a trading range. But also we don't have any important reference points here except this high, which is historical high for the several years. As we don't have any extremes which could have given us reference points to decide whether price is too high or too low, possibly we don't have to look at the chart itself to decide whether the price is high or low. When we have situations looking like this one, we have to search for an answer outside of a price chart. What do I mean by that? I mean that we have to look on COT reports and monitor the activity of commercial traders or hedgers who employ currency futures for the purpose of protecting their portfolios, buying or selling certain amount of currency futures. If you are completely unfamiliar with this topic, I recommend you to watch videos Top-Down Analysis Part 1 and Top-Down Analysis Part 2. And now let's look at the chart of Canadian dollar future. I remind you that charts are similar with American dollar versus Canadian, except that it is inverted. And to see participation of large market players, I need to see dynamics of open interest captured from so-called Commitment of Traders reports, or COT. I will not spend time here for explanations. You can watch webinars dedicated to top-down analysis. It is Top-Down Analysis Part 1 and Top-Down Analysis Part 2 to know more about this topic. We see price of Canadian dollar going down, while open interest is rising. We see that these two lines, they are going in opposite directions. And we see that open interest is growing in spite of a trade location which can be perceived as low. I mean that large traders, large speculators who often benefit from changes in price, they are not afraid in selling more and more futures contracts using low price. And on the other hand, commercial traders or hedgers are buying more and more in spite of so-called low price. Of course, we have a lag of approximately 1 week from the date of release of COT report, but even considering this lag, we still see that open interest was growing for several weeks. And you might remember from previous webinars that it happens when the market is accumulating position before trending move. Now, how could we use this situation for our advantage? So we have identified that possibly we have strong trending market conditions and we have to develop a tactical response to enter a long trade. It's not about going short, it's about going long. And you see here my current long position opened from 1.3884. That's my first position, and second position is located 100 pips above. First of all, if I see strong trending market conditions, I see also trading range, and I have to identify rotational center of this trading range, which is visible here by spots of low volatility. They are right here around this level, around 1.3885, spots of low volatility. Then after the market started to test higher levels, I was able to use envelopes to be able to capture the pullback. Here it is. I also was using ATR to place my stop. Here is an ATR indicator. I multiplied by 1.5 or 2, in this case it is 2, to get my stop loss point. That is my entry point. And also note that lowest band of the envelopes crosses the rotational center. So I am able to enter a long position here. Trend is on my side. I know pretty much clearly that many traders are trying to fade that move. They always do. That's why market will go much further than the majority of traders will expect. It means that in strong trending market conditions there is no such thing as high price. You can buy high and sell much higher. Now all I have to do is to manage this position correctly. Well, I am adding some positions here because I see the strong trending market conditions, so I'm able to add the second position. I have added it on 1.3890, 3990, sorry. And then I will think about closing part of my position probably at 1.4180 or so, and my second target is located around 1.45. And another example of recent trade from my account is from gold market. It is typical breakout momentum trade. We have accumulation area here with very low open interest. I will show it on the daily chart. If we switch to the daily chart, you can see that we had pretty long trading range. Started from November, from probably November 15 or so, and open interest within this trading range was decreasing substantially. It means that market possibly is ready to go in whatever direction, we don't know. We never know the final destination. Market can break to any direction. At this time market possibly needs to go higher, and that's why I was able to open long position on a pullback to the support area. Let's now get back to the 30-minute chart, and we are able to see that initiative break or initiative activity occurs within this candlestick, within this bar. And what do we see here? We see that market was trying to test the lower level of this initiative break, but it was unable to violate this level, and that's why it is a sort of a confirmation to go long. And for me it is a signal to go long, to establish a long position. For now market is going in my direction, and all I have to do is to manage this position correctly. But of course, if we again switch to the daily chart, we can see that market looks like very trending, and it's very hard or very difficult to capture a reversal here, but we are not capturing a reversal. We are working, regardless of the previous trend, we are working on the breakout of this accumulation area. And remember that open interest was very low within this trading range, so previous trend may not have very big influence on the situation. We can play this breakout to whatever direction. And two more ideas concerning high-low price fallacy. Sometimes price can be really high in case market conditions are so that there are no other time frame buyers or sellers involved in the action. Again, price is high when market is overbought and price is low when market is oversold. So to be able to say that the price is high or low, you will often have to learn to identify overbought or oversold market conditions. Now look at the pattern located on this slide or on this chart. You see that price had come to long-term high. It is American dollar versus Japanese yen. And you see that price was unable to test this high. And it means that regardless of the strength of the previous trend, it means that possibly we have a local weakness in the market. Market is going to be weak here. And I want to pay strong attention to what I'm going to say right now. You see the gap between long-term high and this trading range. If this gap remains unfilled, it is a confirmation of weakness. It tells us that market is weak and unable to reach longer-term extremes. Weaker-handed traders often close their positions before price reaches the extreme. They start to close their positions. They don't want to hold their positions beyond this extreme, especially historical extreme, historical high or low. So probably this market was dominated by swing traders who were entering this market, and other short-term traders may be also involved in the game, but we possibly have seen no participation of higher time frames. And therefore price can become high if gap remains unfilled and become low if gap is filled. So for example, if we could have seen here market reaching this historical extreme or long-term extreme, price could have become low. It is not very easy to understand, but that's how things work. If different scenario comes into play, it completely changes the landscape and perspective of what is high and what is low. Because if market reaches this point, it means that possibly there were some large market participants involved in the game and they have pretty broad a perspective, and they might push the market up and up, push it higher and higher until it will reach some higher points. So this point, this price level can be considered as low in this case. But once it doesn't happen, price can become high. It has local weakness. And again, I want you to pay some attention to the situation that has occurred in October and November, also on American dollar versus Japanese yen. You see that this pullback was pretty strong, it was pretty volatile. But nevertheless, market was unable to reach 123.70 or so. It is a level of highs established in November. Market was unable to reach this level. It was the indication that possibly short-term players or traders were involved in the game here, and they were unable to push the market above high established in November. So possibly you could have thought about establishing a short position beyond the rotational center here. That's how it works. But what if the market could have accepted higher prices or could have broken out the higher prices, what would have happened here? Well, I don't know exactly, but possibly market would rotate back and forth around this level. We could have seen some acceptance, some rotation, and possibly we would not see such large elongated movement to the downside. And let's move on and talk about catching tops and bottoms. Catching tops and bottoms is a very destructive trading habit, yet it is very popular because beginner traders or overconfident traders often think that they can capture real reversal point. But it has nothing to do with reality. And if you look at this chart, you will notice that having strong trend in play, we have series of new lows. Numerous lows. It can be sequence of 5, 10 or more new lows. Of course, it doesn't mean that you can reverse your view and earn easy money here, because volatility is pretty limited here. Nothing really interesting is happening here. But you know pretty accurately that you will likely have new low rather than reversal point. More often than not, market tends to generate bearish sideways bullish sequence. Or it will go from bearish first to sideways and then to bullish, rather than bearish bullish or bullish bearish. If you look at the Australian dollar versus American dollar, you also can see that strong trending market condition makes the market lean to lower levels. It has new lows and new lows. Then we have elongated pullback. Then again, market was unable to generate upswing here. I was expecting some action to the upside here, but eventually market is going to test lower levels again, 0.70 level again. That is how strong trending market conditions work. Once you have a strong trending market condition, you will see the market leaning to previously achieved lows or highs, like it is shown here. We have a level 0.70 and market leans to this level. It tests this level and possibly will drill deeper, establishing a new low. Maybe not, I don't know, but I know that capturing a reversal is pretty tough, and it's tough both statistically and psychologically, because in most cases you will be wrong and you will not see your positions generating any profit. But why not to open your positions in the direction of the trend? On this slide you see exactly how it works. It is the same gold chart that I was showing you so far. And before market is ready to go, it generates series of upswings with no continuations, series of false breakouts. I don't know exactly whether it is going to generate breakout or meaningful move to the upside right now, but I know that my odds of success are greater now than in previous situations. I know that patience here is on my side. Patience is working in my favor, because if I try to capture this price going with this move or going with this move or this move, I'm going to be stopped out several times. So if I'm patient enough, I'm able to capture good trade location and enter a good position. I don't know whether a continuation will be meaningful or not, but now I'm having paper profit and I can manage this profit. I can take my profit partially or even add to my position. So that is pretty good situation to have. Now let's move on and talk a bit about focusing on volatility. Too much time traders focus on volatility. They think that volatility is a sign of something meaningful happening in the market. But in most cases, volatility can be either the culminational phase of the move, or it can be a sign of big volumes that stepped in the market, they push the market up or push the market down, and that's it. They have executed their trade, and that's it. We may see no continuation. And if you just focus on volatility, if you wait for the break, if you wait for the trending day to join the market, you might be very disappointed that you see no continuation after that. And as I have said in previous webinars, I would prefer to have low volatility rather than high volatility. I would prefer to have very tight trading range with small volatility and to capture breakout from this range, because I want to go one step ahead of the market. Volatility is good when you're in position, but it is not good when you're not in position. So if, for example, you enter the position right here, it is very good if you have volatility occurring in the marketplace. Or, for example, if you enter the position somewhere early in the day and then volatility is followed, that is excellent. But volatility can be very rarely the sign of initiative activity. More often than not, it is a sign of culminational phase or culminational activity. It can be initiative in very minor cases when you have large trading range lasting for about 6 months, I don't know, and then you have a break of this trading range and market will ready to go. It might go after the large trading day, but it is very rare case. So I would not suggest you to focus on volatility, because in most cases it will be the final phase of the movement. I would prefer to let this situation go and to search for the next pattern. It will be possibly a wise decision. Let this market go. Market will be there tomorrow. You will capture your opportunity if you are patient enough. Market provides us opportunities every day, every week, and I hope it will be so in the future as well. And in the end of our webinar, I want to say a few words about these two mistakes, such as ignoring market conditions and capturing one good trade. Well, I was underlying the importance of market conditions or basic market conditions in the first two webinars titled The Non-Random Way to Trade Part 1 and The Non-Random Way to Trade Part 2. If you rely just on technical analysis, just on chart analysis, ignoring any fundamentals, ignoring any open interest, any volume, any big picture perspective, you're about to get into trouble very quickly, because you can't just go with the price all the time and earn consistent profit, because price itself is an advertising mechanism. It's nothing more than that. And capturing chart patterns may be good to develop a tactical response, but as a main strategy, as a basic strategy, it will generate unstable results. That's why you will have to learn how to identify basic market conditions, to know whether the market is trending or not, to learn how to capture open interest, how to view the open interest and to see whether big market participants are in the game or not. That is market conditions. Also, it can be fundamental analysis or seasonal analysis or so, but if you ignore this type of analysis, this type of preparation, you are about to get into trouble. That's not that your technical analysis is bad. No, technical analysis simply is not designed to be a strategy. Technical analysis is not a strategy. I will repeat it once again. It is tactical response. It allows you to see what is happening right now at the right side of the chart, but it will not give you the clue of what will happen in the future. Traders often make this mistake of ignoring market conditions and relying just on technical analysis, because technical analysis is much more simple for understanding. They just draw lines, charts, the chart patterns. They can draw head and shoulders, triangles, and so on and so forth, because it is easy to understand. Traders want to simplify the process, and that's why they like technical analysis. And that's why they tend to ignore all conflicting information, all other information that is not so easy to grasp, not so easy to understand. So what is about the last point? I call it one good trade because traders too often want to enter a position using small time frame like M30, M15 or even M5, and then they want to hold this position forever. Well, I'm a bit exaggerating, but they want to get the swing of 500 pips using the stop of 5 pips or 10 pips or 15 pips or so. It is very difficult, and first of all, to become consistent trader you have to align your trading with your time frame, even if your profits in single trades will be limited. With that, we are going to finish our webinar. Yet I don't close this topic, and I'm going to talk about this topic in future as well, because there are many mistakes that traders make over and over again. If you have any questions or comments to this video, feel free to leave it below and I will do my best to answer all of your questions. Please be specific to receive a good answer. Good luck and see you in the next videos.